Pledge Finance is looking to disrupt lending and borrowing with a unique approach I haven't seen anywhere else. They call themselves the world's leading marketplace for financial NFTs, and their core products are fixed rate, fixed term loans that are different from what other DeFi protocols offer. But before we dive in, a quick disclaimer that this is a sponsored overview video of this project. They do have a token, but I am not telling you to buy it at all. In fact, given that we're in a bear market right now, I wouldn't recommend speculating on any small cap altcoin currently. But here's the thing, you can use their platform to lend, borrow, and earn interest without holding their token at all. So that's what I want to focus on in this video, to give you a better understanding of their platform and approach to see if you might want to use it. Alright, so at the highest level, Pledge Finance is a decentralized bank. But to get more specific, they are a protocol running on Binance Smart Chain that offers fixed rate, fixed term lending and borrowing of crypto assets. Now, why is that useful? Well, you can use this platform to lend your coins and earn much higher rates than what traditional banks offer in like a savings account. Pledge Finance can afford to give you higher rates because they don't need underwriters and they don't need to build out physical branches either. Everything is handled by software and smart contracts, so the savings can be passed through to us users. Also, this fixed rate financing that Pledge Finance offers is really big in the traditional finance space. It's better than variable rate loans because this offers more certainty and it lets users minimize their risk. This is why bonds have fixed rate terms as well. So Pledge Finance aims to bring these financial products to the DeFi space. Their loans are actually called non-recourse loans because the lender can only seize the collateral that's put up in the loan, even if its value drops and cannot cover the entire debt. These non-recourse loans are super popular in traditional finance, so I think it makes a ton of sense to bring it over to DeFi too. This type of product is amazing for whales or miners because they can use these loans to reduce their tax bills or finance their operations. But also, us regular users get the same rates too, so everyone can take advantage of this platform. Alright, time for the good stuff, aka how this platform works and why I think it's unique. Okay, so this is what their V2 interface looks like. On the home dashboard, you can see the different pools available to enter as a lender or borrower. If you click the detail button, you can go into the lender view like this and see all the details for that pool. Or you can flip the tab to the borrower page to see the details there and put in your orders. The interface itself is super simple. There's not like 100 buttons or fields to interact with. But it's worth understanding what goes on behind the scenes because it's quite different from other lending and borrowing protocols out there. So there's 4 overall phases to their process when someone uses their platform. The marketing phase, settlement phase, maturity phase, and claim phase. The marketing phase is where the lenders and borrowers come together to form a market. They actually use pools to facilitate the lending and borrowing. So for example, lenders deposit BUSD stablecoin and borrowers deposit BTC into an escrow pool. They can choose from a variety of pools where they see the fixed rate, total amount deposited so far, settlement date, and other important information. The interface shows the lender or borrower how many senior or junior tokens they will receive. More on this in a bit. And also their expected interest. To put in your orders, you just go through the typical MetaMask workflow and then you wait for the next phase, the settlement phase. During this phase, the smart contracts make sure that everything is balanced. If there's too much in the pool from the lender side, then some of their stablecoins are returned. If there's too much from the borrower side, then some of their collateral is returned. And once everything is balanced, the system distributes the loans. So the borrower gets their stablecoins that they wanted to borrow, plus their junior pledge tokens, or JP tokens for short. The lenders get their senior pledge tokens, or SP tokens, and this is all proportional depending on the amount they deposited. This structure of having senior and junior tokens is super unique because these tokens are all fungible and they represent a claim on the collateral. So the beauty of this approach is that you can trade them for quick liquidity even after you've entered your loan agreements. You can even stake these SP and JP tokens on Pledge Finance or provide them as liquidity on a PancakeSwap pool, and you can earn extra rewards by doing these. It's called senior and junior, by the way, because the senior tokens that the lender is given gets to collect first from the pool before the junior token holder gets any remaining collateral. The third phase is the maturity phase, and this is when the pool automatically sells the collateral on the market for stablecoins. They sell enough to cover the lender's amount plus the interest that was promised to them. And if there's any collateral left over, then that can be claimed by the borrowers. The fourth and final phase is the claim phase. So in order to receive their initial investment plus interest, lenders send in their SP tokens to the pool, and borrowers send in their JP tokens back to the pool to claim any remaining collateral. If you traded any of your SP or JP tokens before the maturity date, then you can still send back what you have, but the amount you receive will be prorated accordingly. And then boom, that's the whole process. You do have to do these steps manually, by the way, so it's important to keep track of the dates and times of each phase once you enter a loan on either side. There's two really important things that we're missing though. First, borrowers do not need to pay back their loan at maturity, like other protocols make you do. Your collateral is automatically liquidated at maturity to cover the lender's rate of return. And if there's anything left, depending on if the price fluctuated for your collateral, then you can get that back. They also get to keep the stable coins that they borrowed in the first place. Second, lenders do not have to worry about borrowers restructuring their loans, so the whole system is a much more predictable process. You also get fast liquidity with your SP tokens because they are fungible and you can sell them on the market, or you can stake/provide liquidity to earn some rewards. I think this is a super cool approach to lending and borrowing with these fixed terms and also this junior and senior token approach. You know, this is actually their V2 product and they've come a long way since their V1. In their V1, their loans could not be restructured and they did not have these two separate tokens. Instead, they had these tokens called P-notes that were non-fungible. In the future, they plan on introducing NFTs as collateral for the pools too, which is a fascinating use case for you big-time collectors to get some liquidity on your NFTs. I think the best way to tell whether or not a project will deliver on their roadmap is by looking at the team. And when I look at the Pledge Finance team, I come away pretty impressed. They're led by Tony Chan, who's ex-Microsoft and Stanford alum. Then there's Nicole Chang, who's a former VP of East West Bank and ex-president of Stanford's Business School's Alumni Association. Their advisors include high-profile names like Brian Brooks, who's a former high-profile regulator for the US government. And Jeff Strand is a Stanford Law School professor who's also an advisor. And lastly, their investors include names like GSR and DHVC from Silicon Valley. So my takeaway is that if you do lending or borrowing, Pledge Finance is definitely a platform to try out to see if it fits your needs. They're doing a lot of interesting things with their fixed term loans and senior junior token structure. And they could be a great way to earn yield on your coins. So go check them out using my link below. See ya!